Let me hit you with a truth people are avoiding. The global economy is changing faster than your newsfeed can update. And if you're not paying attention, you're the last one to know when the floor drops out. France calling out China's export machine, the West scrambling for leverage it doesn't actually have, Japan shaking the U.S. bond market. These aren't headlines. These are warning sirens. And here's the wild part. Every one of these events is connected. You understand this chain. You understand where the next shock hits and how to stay ahead of it. Before we go deeper, make sure you're following along. If you want more breakdowns like this, the kind that cut through fear, confusion, and noise, hit that follow, share this, and make sure you stay tapped in. Because this is the information that keeps you prepared, not panicked. France's growing frustration with China's export dominance comes from a pressure that has been building for years, not months. When French leaders criticize China's manufacturing strength, they aren't just reacting emotionally. They're reacting to a structural imbalance that European industries feel every single day. China produces goods at a speed, scale, and cost that Western factories simply cannot match without dramatically reshaping their own systems. This means French manufacturers constantly face competition that undercuts their prices, shortens their market share, and reduces their ability to innovate at a sustainable pace. Even when Europe tries to protect its industries through policy or regulation, the sheer volume of Chinese exports makes those efforts feel like placing sandbags against a rising tide. But beneath the political language, what's really happening is a deeper economic insecurity. European economies were built on decades of industrial strength, but globalization shifted the center of gravity. Factories moved offshore, supply chains spread across continents, and China became the central hub for low-cost, high-volume production. So when France voices its concerns, it's actually expressing the fear that domestic industries may never regain their former dominance. This is not just about factories, it's about national identity, jobs, innovation, and long-term economic confidence. Another layer of frustration comes from dependency. Europe depends heavily on Chinese inputs, components, raw materials, electronics, to keep its own industries running. So even when European leaders criticize China's export practices, they know their supply chains rely on those exact same imports. It creates a conflict between economic necessity and political pressure. They want fairness, but they also need stability. They want balanced trade, but they also rely on lower-cost goods to maintain consumer affordability. France's criticism becomes a symbolic act, a way of saying what many Western nations feel but don't always voice publicly. It's not just a comment about trade, it's a reflection of a shifting world order, where economic power is becoming more dispersed. France is reacting to the reality that global competition is no longer predictable or comfortable, and unless European industries adapt, innovate, and rethink their strategies, they risk falling further behind in a world where manufacturing speed and cost determine influence. The idea that the West is struggling to find real leverage over China comes from a hard economic truth. Modern global supply chains have been built around Chinese efficiency for decades, and you can't simply undo that dependence with politics or pressure. Western countries talk about reshoring, diversification, and reducing reliance. But the reality underneath those talking points is that China controls massive portions of global manufacturing, rare earth processing, battery materials, solar components, electronics, and countless everyday goods. That level of embedded influence doesn't disappear just because another country wants it to. So when leaders in Europe or the United States attempt to push back, they often find themselves negotiating from a position of need rather than strength. What makes it more complicated is that Western leverage used to come from technological dominance and institutional power. But today, manufacturing capacity and supply chain control carry as much weight as innovation. If a country can produce faster and cheaper, it becomes indispensable. China has positioned itself exactly in that space. This gives Beijing quiet leverage. not loud, not aggressive, but structural. When a country is the main source for your imports, your infrastructure, your renewable technology, and even parts of your healthcare supply chain, you have limited room to maneuver. This lack of leverage becomes most visible during economic disputes. Western nations may threaten tariffs, restrictions, or trade rules, but those moves often hit domestic businesses and consumers just as hard. A tariff on a Chinese product raises costs for Western companies that rely on those parts. A restriction on Chinese technology slows down industries that depend on it. Even attempts to build alternative supply chains in Southeast Asia or Latin America move slowly because China already dominates logistics, ports, and production networks across those regions. So the West faces a paradox. It wants to reshape its economic relationship with China without disrupting its own stability. It wants to regain control, but it relies on the very systems it hopes to replace. The imbalance isn't about who is stronger politically. It's about who controls the essential components of the global economy. Until Western nations rebuild their own manufacturing base or redesign supply chains, their leverage remains limited, not by lack of will, but by the economic architecture they helped create. Japan's influence on global financial markets comes from a unique position it has held for decades. As one of the largest holders of U.S. Treasuries and a country known for ultra-low interest rates, any shift in Japan's monetary policy sends ripples through the entire global system. When Japan adjusts its rates, even by a small amount, investors around the world pay attention because the change alters trillions of dollars worth of financial assumptions. For years, Japanese investors borrowed cheaply at home and invested abroad, especially in U.S. government bonds. This flow of money kept U.S. borrowing costs lower than they might have been otherwise, which was convenient for America's massive debt needs. But when Japan signals that rates are rising at home, those investors reconsider. If domestic yields look more attractive, money starts flowing back into Japan, and that movement can accelerate fast. As capital returns to Japan, demand for U.S. Treasuries weakens. When demand drops, yields rise, and rising yields create pressure on the U.S. bond market. It isn't a dramatic crash, but a tightening of financial conditions that affects everything from mortgages to business loans to government spending. This is why even a modest shift in Japanese policy grabs headlines. Japan's interest rate decisions act like a valve on global liquidity. When the valve tightens, money becomes more expensive. When the valve opens, markets breathe. But lately, Japan has been under pressure to normalize its monetary policy because inflation has crept into its economy after years of stagnation. This forces the Bank of Japan to consider raising rates, and that consideration alone is enough to unsettle global markets. It also exposes a vulnerability in the U.S. financial system. The United States depends heavily on foreign buyers to absorb its continuous issuance of debt. If major buyers like Japan pull back, the U.S. must offer higher yields to attract new investors, which increases borrowing costs across multiple sectors. Rising yields can drag down stock markets, strain government budgets, and elevate the risk of financial instability. Japan doesn't intend to disrupt the U.S. economy, but its moves inevitably create waves. In a world where national policies are intertwined, Japan's rate adjustments become a reminder that even the most stable financial relationships can shift when domestic priorities change, and those shifts reshape markets far beyond their borders. The global economy is moving into a new era defined by what many describe as competition, resilience, and rebalancing. And this shift affects every country, whether they acknowledge it or not. For decades, the world operated on an almost predictable rhythm: low-cost manufacturing from Asia, high consumption from the West, stable, financial markets supported by cheap money, and global cooperation that made trade feel frictionless. But those conditions are fading. Rising geopolitical tensions, supply chain disruptions, energy volatility and changing demographics are forcing nations to rethink how they participate in the global system. The era of assuming everything will stay stable is over. Countries are now competing more aggressively to protect their industries, secure their resources, and shape the future of technology. This competition isn't just about who makes what, it's about who controls the systems that keep economies alive. Energy supplies, semiconductor production, rare earth minerals, battery technology, agricultural output, and manufacturing speed are now the battlegrounds for influence. Countries want to reduce dependencies, build domestic capacity, and ensure they can withstand shocks like pandemics or conflicts. This is where resilience becomes essential. Instead of relying on a single source for essential goods, nations are trying to diversify supply chains, invest in new infrastructure, and prepare for disruptions before they happen. The goal is not isolation, but stability, the ability to keep functioning even when external pressures rise. At the same time, the rebalancing of global power is accelerating. Traditional economic leaders like the United States and Europe face competition from rising economies that have strengthened their manufacturing and technological bases. China, India, Southeast Asia, and parts of the Middle East are shaping global markets in ways that didn't happen 20 years ago. This shift means economic influence is no longer concentrated in a handful of Western countries. The balance is spreading, and with that spread comes new alliances, new trade routes, and new rules. It also means countries must adjust their strategies if they want to remain competitive and relevant. For individuals, this era signals a need to stay informed and adaptable because the rules of global economics are being rewritten in real time. Those who understand the shifts can position themselves to thrive, while those who ignore them may feel the impact only when it becomes unavoidable. Western nations often express strong political positions toward China, but the gap between political rhetoric and economic reality has become increasingly clear. Leaders may speak confidently about reducing dependence, reshaping trade, or pushing back against practices they view as unfair, yet the economic systems underneath those statements tell a different story. Over decades, Western economies allowed manufacturing to shift overseas, supply chains to become globalized, and cost efficiency to outrank strategic independence. As a result, many of the goods that people rely on daily, electronics, machinery, pharmaceuticals, raw materials, renewable energy components, are either produced in China or involve Chinese inputs somewhere along the line. This creates a disconnect. Politicians want leverage, but businesses want stability and affordability, and consumers want prices they can actually manage. The desire for political distance collides with the reality of economic interdependence. This gap becomes especially visible when governments try to implement restrictions or tariffs. Although the intention may be to protect domestic industries or assert national strength, the result often ends up putting pressure on local businesses that rely on global supply chains. Companies face higher costs, delays, and uncertainty, which then trickles down to consumers. Political decisions meant to send a message sometimes end up creating stress for the very industries they aim to support. Western leaders understand this dynamic, making it difficult to take strong actions without affecting their own economies. So while statements can sound bold and uncompromising, the follow-through is frequently limited because the economic consequences are too significant. There's also a challenge in rebuilding domestic capabilities. Reviving manufacturing, securing new supply chains, and investing in local production are long, expensive processes. They require coordination across government, industry, and workforce development. Even when Western nations set ambitious goals to reduce reliance on China, the timelines stretch into years or even decades. Meanwhile, China continues advancing in manufacturing technology, logistics efficiency, and global partnerships, widening the gap that Western countries are trying to close. This mismatch between political ambition and economic reality creates a sense of frustration within Western governments and industries. They want to reshape the relationship, but finding alternatives that match the scale and speed of China's system is extremely difficult. Until that gap narrows, Western leverage remains more rhetorical than practical, driven by intention rather than grounded in the structural power needed to make those shifts immediately effective. Ignoring economic warning signs until markets force a correction is one of the riskiest behaviors for any country, business, or individual. The global economy functions on a complex web of signals: interest rates, trade imbalances, currency flows, debt levels, supply chain bottlenecks, and consumer behavior. When leaders or investors fail to pay attention to these indicators, they leave themselves vulnerable to sudden shocks that could have been anticipated or mitigated. History is full of examples where warnings were ignored because short term appearances were comforting, political agendas dominated, or the consequences seemed too distant. Yet when the correction comes, it arrives with a speed and intensity that can overwhelm preparation, wiping out years of growth, confidence, or financial stability. One reason economic warnings are often ignored is that the indicators can be technical or subtle. Trade deficits, rising government debt, or shifts in foreign investment flows may not capture headlines, but they accumulate risk quietly. Markets sense this tension and begin to adjust, sometimes gradually, sometimes violently. Investors who rely solely on past trends rather than observing these evolving signals can be caught off guard, facing losses that could have been minimized with proactive measures. Similarly, governments that fail to recognize structural vulnerabilities, like over-reliance on imports from a single country or unsustainable borrowing, can find themselves forced into reactionary policies rather than strategic planning. Another factor is cognitive bias. People naturally hope that crises will be avoided or that current trends will continue indefinitely. Politicians and business leaders often focus on what is immediate and visible rather than what is hidden or emerging. This creates a delay in action, which magnifies the impact when the inevitable adjustment arrives. By the time corrective measures are taken, they are often more severe, more disruptive, and more painful than if the risks had been addressed in advance. The lesson is clear. Economic signals exist for a reason, and ignoring them is a form of self-inflicted vulnerability. Awareness, careful analysis, and early action provide an opportunity to reduce exposure and adapt strategy. Waiting for the market to force change removes choice, increases uncertainty, and amplifies consequences. Those who monitor, interpret, and respond to these warnings position themselves to navigate volatility rather than be crushed by it, demonstrating that foresight is not just a competitive advantage, it is a survival skill in an interconnected global economy. In today's interconnected global economy, the need for individuals to stay informed, adaptive, and proactive has never been greater. Governments and corporations often respond to shifts in policy, trade, and finance in ways that can affect ordinary people almost immediately, from the cost of everyday goods to the stability of investments and employment opportunities. While national leaders focus on macroeconomic strategies, the ripple effects reach households and businesses that may have little influence over the larger decisions. This makes personal awareness and adaptability essential, not optional. Being informed allows individuals to understand why prices fluctuate, why supply chains sometimes falter, and why certain industries experience sudden growth or decline. It transforms passive observation into actionable insight. Adaptability comes from recognizing that change is constant and that strategies that worked yesterday may no longer be effective. Careers, investments, and even consumer behavior need to align with evolving conditions. For example, industries reliant on global trade can be disrupted by shifts in tariffs, foreign policy, or currency. Values, requiring workers and entrepreneurs to pivot their skills or operations. Individuals who cultivate flexibility, whether through continuous learning, diversified income streams, or technological literacy, are better positioned to respond to these shifts rather than be blindsided by them. This adaptability is not about predicting every twist in the market. It's about having the capacity to adjust quickly and effectively when conditions change. Being proactive also means taking responsibility for understanding the forces that shape personal and financial well-being. Reading reliable economic analysis, monitoring market trends, and critically assessing political decisions are all part of staying ahead. Waiting for crises to appear before reacting often leads to unnecessary stress and missed opportunities. Those who anticipate and prepare can mitigate risks, seize opportunities, and maintain stability even when broader systems are in flux. Ultimately, the combination of awareness, adaptability, and proactive engagement transforms uncertainty from a source of anxiety into a manageable challenge. Individuals who embrace these qualities gain a measure of control in a world where global decisions, from international trade to financial policy, can have immediate and far reaching impacts. In this new era, personal preparedness is as crucial as national strategy, enabling people to thrive rather than merely survive in an unpredictable economic landscape.